The two biggest problems day traders face are number one, finding a profitable strategy, and number two, mastering trading psychology. This video is going to be a deep dive on how to master number two. Now, why master trading psychology? Because consistency. The more that you can master your trading psychology, the more consistently that you can do well in trading. It's one thing to learn how to profit from a trade. It's an entirely different thing to be able to do that consistently. And to show us how to master trading psychology, we're going to learn from the best teacher of trading psychology of all time, Mark Douglas. I want to introduce you to this man because Mark Douglas is a name every serious trader should know about. And if you've never heard of him, it's probably because he's dead. He actually passed away in 2015. May he rest in peace. So I'm incredibly grateful to be able to pass on some of his teachings to you. He was a pioneer in understanding how the real battle in trading is not on the charts. It's in your mind. And he didn't just talk about discipline or mindset like you've heard from everyone else. Instead, he figured out how to break down the hidden ways that our emotions sabotage us. And he will show us how to reprogram our thinking to build the kind of consistency that separates the winners from the losers. So if you've ever felt stuck, taken over by your emotions, or unable to stick to your rules, listen very closely to these principles because this right here could be the turning point in your journey. With that said, meet Mark Douglas.
My name is Mark Douglas, and I'm the author of The Disciplined Trader and Trading in the Zone. I've been a trading coach since 1982, and over the years, I've worked with some of the industry's biggest hedge fund and money managers, as well as some of the exchange's largest floor traders. I know that all of you want to experience consistent results from your trading. In other words, you want to be able to generate an income you can rely on. However, one of the major obstacles in trying to accomplish this objective is in the area of trade execution. To produce a consistent income, a trader has to be able to execute their trades without making any errors or mistakes. In other words, trading without hesitation, reservation, or internal conflict. Basically, all of the errors we are susceptible to are a result of a lack of confidence, or more specifically, trading with fear. What most people don't realize is that trading without fear is actually a learned trading skill, a skill that has to be cultivated and is the primary difference that separates the professional from the typical trader.
Okay, so let's outline his key points here. Number one, consistency is the goal of trading psychology. And of course, by that, we mean consistently profitable. Number two, consistency is the result of eliminating trading errors. And number three, trading errors come from two places, fear and lack of confidence. For example, internal conflict and hesitation. And the last point, which is the most important one, this is all a learned skill. I'll say it again, this is all a learned skill. And he says if you don't believe him, like you don't just buy this whole trading psychology stuff, don't take his word for it, and don't take my word for it. Do this experiment to test it out and see for yourself. Set up a paper trading account, perform your exact trading setup on a simulator, let's say for a week, and see how many errors you make. You'll notice you make very few. Now go to a live account or a prop firm account, your choice, and execute the exact same strategy, exactly the same way, and you will find that the amount of your execution errors goes up significantly. Now, how could that be? The answer is, of course, trading psychology. So that's evidence that this is absolutely a learned skill, and it is exactly what is missing in your performance between the simulated and the live account. And the good news here, and the reason why I'm doing this presentation, is because it can be learned. So if you're dealing with these problems currently, know that you can transform them and create a breakthrough for yourself and your trading results by gaining this new skill. Now, speaking of consistency, let's get to the 7 principles of consistency. Mark Douglas came up with something, the 7 principles. His 7 principles of consistency and the 5 fundamentals, they've helped me more than anything. They're outlined on your screen here. And if you want to download this free infographic, watch to the end of this video and I'll share a link where you can download this for free. How do you master trading consistency? And how can trading psychology help you? The first thing you have to do is you have to identify your edge. This is the foundation of consistent trading. There's no consistency without defining your edge. Now, a lot of traders, they maybe have learned about trading and learned about trading strategy, but maybe they're not actually clear on their edge. Are you? So that's an important detail. You need to know what your edge is. Now, what's an edge? Your edge is your setup. That's your setup. Shout out to my man Bobby from San Diego. I'm in San Diego too, man. Your setup is a technical pattern. That's the pattern that you look for, right? So you have to understand it well And when you understand what that pattern is, what you should know is what the probability is that favors your setup, right? So this is how you systematize your trading. And this is a really simple way of seeing it. You go, okay, I wait for this setup. When I get this setup, I know that means the odds go in my favor about this, okay? And obviously, it means that the odds are, you have better than a 50% probability. But sometimes you can do a little better than that. So there are certain times in the market, right, when it's trending heavily, for example, and it's more than 60% or so probability. So you want to have a basic idea of when the odds are in your favor and what the pattern it is that you look for. That's your edge, and that's how you define your edge. And so if you don't have this to define, then there's no point in working on your trading psychology. So this would be step one. All right. And shout out to my man Glebo. He's tuning in from Northern Germany. Good vibes only. Very good. Yes. Oh my God, there's so much negativity on the internet, right? This will not be one of them. In my experience, as far as my edge goes, I have 3. Now, if you have subscribed to my 3 setups, you can get those for free at tradesbybren.com/3setups. You can see my 3 setups. But my favorite setup is a pullback setup, and that's for trend continuation. And that's setup number 2 in that downloadable document, which you can get. I give it away for free. And when that happens, I know that when the market is in a trend and it pulls back, that it often offers a high probability entry point. So that's when you get, say, a leg, you call it a leg in one direction. The odds of a second leg after it pulls back for trend continuation is somewhere between 60% and 90% odds. It's going to be around 60% most of the time, but it can be as high as 90%. That's when there's high level of momentum. And this clear edge gives me the confidence to execute and assume risk. So that's why this is important, because you just know that the odds are in your favor. And when the fear comes up, you can take that risk because you know that the likelihood of winning exceeds the likelihood of losing. It's simple, but it works. All right. So now that we've talked about consistency and edge, let's talk about predefining your risk. So I'm just going to share with you guys the 7 principles of consistency. Okay. So you're going to want to write these down because you're not going to see them on the screen. I'm just going to tell them to you, and you're going to have to give it some effort here. Okay. So here are the 7 principles of consistency from Mark Douglas, and these are gold. So you want to remember these and write them down. The first one is number 1. I objectively identify my edge. So we just talked about that, right? You can objectively and clearly identify what your edge is. That means your setup, okay? Number 2, I predefine the risk before every trade, okay? So we're going to talk about that in a minute, but that's rule number 2. Number 3, and I'll give them all to you right now. Number 3, I completely accept the risk, or I'm willing to stay out. I completely accept the risk, or I stay out. Number 4, I act on my setup without hesitation. I act when I see my setup without hesitation. Number 5, I pay myself as the market moves my way. In other words, I take profits as the market moves my way. Number 6, I continually monitor my susceptibility for making errors. Number 6, I continually monitor my susceptibility for making errors. Number 7, the 7th principle of consistency. I understand the absolute necessity of these principles of consistency, and therefore I do not break them. Okay? So principle number 7 is I don't break the rules. Okay? Rule number 7 is I don't break the rules. All right? So I'll go through these one more time very quickly. The 7 principles of consistency. And again, credit to Mark Douglas. Number 1, I objectively identify my edge. Number 2, I predefine my risk before every trade. Number 3, I completely accept the risk or I stay out. Number 4, I execute when I see my edge without hesitation. Number 5, I pay myself as the market goes my way. Number 6, I continually monitor my susceptibility for making errors. Number 7, I know, I understand the absolute necessity of these rules, and I do not break them because these are rules of consistency. Okay. So those are the 7 principles of consistency. I'll give them to you all right now, and get those and apply these. And if you want, work on one each day, right? So Monday, you'll work on objectively identifying your edge. So you should have your edge identified. And then Monday, you just practice. Okay, there it is. There's my setup. There's my setup. There's my setup. There's my setup. On Tuesday, every single trade, you say, okay, I'm going to set that stop loss before I enter the trade. And you practice doing that and make sure that you do not enter a trade unless you're entering with a stop loss. A good way to do that is bracket orders. You don't know how to use those, make sure you learn how to use bracket orders. Number 3, I completely accept the risk or I stay out. So that's another great one to practice. So now we'll be on Wednesday and you'll just look at a trade and you'll say, either I enter or I don't enter. You just make it very black and white. Okay, and then you can go down the list and you can practice one every day. So that's a suggestion for you. Now let's talk about predefining your risk, taking control of your trades. But make sure that you guys are with me. So post some dollar signs in the chat if you're with me so far. Okay, post some dollar signs in the chat if you're with me so far, so I know that the sound levels, the volume's coming through loud and clear. Make sure that, yeah, okay, good. Okay, now taking control of your trades, predefining your risk. Before entering a trade, you determine your stop loss level. Now, this means you have to make sure that if you're an optimist, that you include some pessimism, okay? You have to include some pessimism because in trading, you need to be both optimistic and pessimistic. Okay, good. We're seeing dollar signs in the chat. That means you're with me. Beautiful. So you need to define your stop loss before you enter. This is a rule that everyone needs to be applying. Now, some people think this isn't important and they're idiots. I'll say it right now. I'm not trying to be negative, just saying that's like speeding on the freeway without a seatbelt. You would not do that. Okay, so you need a stop loss just in case. So you define that stop loss, which is your maximum potential loss, allowing you to manage your risk effectively. This is effective risk management 101. The lesson learned is I once missed a profit target due to not having a predefined stop loss, and the trade moved against me. Okay, then that caused a significant loss. And I learned that without predefining a risk, you're essentially gambling. Okay, that's really the bottom line. So the difference between a professional and an amateur is they're thinking about the risk. So if you're not thinking about the risk, start thinking about the risk as well as the reward. They're both equally important elements of trade structure. And 2, if you're not thinking about risk, challenge yourself to think about it more clearly. And Glebo in the chat says he has a trading buddy who helps him. He's pessimistic and it gives him balance. That's good, Glebo, but you need to make sure that you're working on developing that cognitive skill within yourself, right? You should be able to look at the trade and say, okay, counter logic. I see it this way, but then I see it this way. If I'm right, then this will happen. If I'm wrong, then this will happen. So that way you're using your brain both directions, back and forth, because trading is buyers and sellers. So you want to be able to move your mind and be very flexible and agile in your thinking so you can go back and forth. Okay. So next is accepting risk. We're talking about predefining your risk. Now we want to talk about accepting the risk, because once you predefine the risk, now you enter the trade, right? And if you predefine your risk, well, then some fear might come up, right? So there's 3 levels to this, to accepting the risk. Because when we talk about accepting the risk, you're talking about embracing uncertainty and taking action. Because when that setup's there, once you define the risk, then fear can come up and it can stop you. So level 1 is acceptance. You have to accept it. Then you have to execute it. And then you have to be confident, right? Because another temptation once you execute and you're in that trade is to panic out. You don't want to do that. And I've struggled with that. And I'm still working on that, honestly. So you want to work on this. We all should be working on this. And by accepting the risk of each trade, you'll be able to execute with more confidence. So you should start thinking of yourself as more like a rule-based machine. You go, okay, if this, then this. If this happens, then I do this. If this happens, then I do this. And you just start learning how to operate in a more machine-like way. That's how you That's really how you become a more effective trader. 3 levels of accepting the risk. The first one is acceptance, right? This is how to embrace uncertainty. Accept the risk, then you execute, then you have the confidence. And the confidence allows you to not panic out, right? Because the problem with trading is you have so much control, right? You can just panic out, and it's the hardest part about trading because you have total freedom. Like you can panic out of any decision that you make, and that's how people get tilted and how trading psychology goes down the drain and how people can lose a lot of money. You don't want to do that. You want to have confidence. The trading will test your confidence hugely. So you want to make sure that you're willing to stick with the decisions you make. This means understanding that losses are part of the process. And what do? You don't try to avoid losses like you're afraid of them. You focus on your edge instead of fearing potential outcomes. Okay, so let's move on. Acting on your edge without hesitation. You trust your system, right? Why do you define? Claudio, what's up, man? Long time no talk. Shout out to my man Claudio from Germany. Now, you want to act on your edge without hesitation, right? So you trust your system. This is how you attain consistency. You trust your system. First, you start with doubt, then there's hesitation, then there's a missed opportunity. And you can see that it inches up, right? So once the doubts come in, the doubts are like the breeding ground for hesitation. The hesitation's the breeding ground for missed opportunities. And that's when the FOMO kicks in. And that's not what you want. Okay. So the second that you have doubt come in, you want to kill it and say, no, I trust my system. I trust my system. Okay. Overcoming hesitation and trusting your system is crucial. Second guessing can lead to missed opportunities, and it often stems from a lack of confidence in your edge, right? By your edge, we mean your system. So you trust your plan. That allows you to act decisively and capitalize on market opportunities. Are you with me? If you're with me, type hell yeah in the chat. Next, feedback from the market. So now we get into adapting and evolving. 3 parts here. First, observe, then adapt, then profit. Once you get feedback from the market. So this is when you enter a trade, pay attention to the feedback of the market. How does the market react once you enter? How does it react? Are you seeing patterns in its behavior that influence your decision? So if you think the market's doing something, like you think the market's trending, for example, and you enter expecting more trend, and then the market does the opposite of what you're expecting, is that influencing your decisions? And are you changing your process based on what the market's doing? Or are you figuring out how to work with the market and how to still follow your process regardless? Okay. The next part is adapt. What you want to do is embrace a growth mindset. There's 2 types of mindsets. People have fixed mindsets or growth mindsets. Fixed mindset means people are just the way that they are. And that's how most people think. And then there's the growth mindset, which means you're always seeking to learn and improve, and that failure are opportunities for growth. So that's growth mindset. And if your trade isn't working, you want to consider adjusting your strategy based on the market's feedback, but not to the point where you're breaking your system. I want to make that very clear, right? So if you enter on a pullback, you want to consider, for example, entering in a different location, right? Or maybe that you missed the setup, and then that's okay. All right. So that's the adaptation phase. And then there's the profiting phase. So by adapting and evolving, you make better trade decisions and increase your chances of success. So you don't want to be rigid, but you also don't want to be abandoning your system as well. There's a certain level of adaptation and flexibility, and there's a certain level of rigor and discipline that needs to be applied in equal measure, probably. Okay. So that's adapting and evolving. That's key. That's important. Let's keep moving. The next is detaching from the outcome. Now, one of the most important things that I've had to learn that I really struggled with is just trusting the process. Trading consistently, well, is all about process. And it's all about executing a process over and over and over and over again. Okay. So 2 keys here that I want to share. The first one is focusing on the process, and that's your system. So once you have that setup predefined and your risk management strategy is in place, the outcome of each individual trade is less important than your overall consistency in your approach. Okay. So you don't want to be nitpicking and really criticizing yourself. And that's one of the things that I've struggled with the most, because I'm a big perfectionist. So I've had to change this and learn how to be less critical of myself and more accepting of myself when I fail or when I don't execute perfectly, which is often, right? Because you're a human being. The next part is accepting losses. Now, losses are inevitable. Amateurs have no understanding of this at all. I see it in the comments on the YouTube channel all the time, right? They think a loss is bad. It's not bad at all. You know, losses, it's like inhaling and exhaling, right? Like you need both, and you're going to have wins and losses in a trading strategy no matter what. And a higher win rate doesn't mean that you make more money, because there's traders with an 80% win rate that are actually losing money and they're not even profitable. And there's traders with a 40% win rate that are wildly profitable because their average win is bigger than their average loss. Think about the math on that. So win rate is less important. It's really not that important. And if you want to learn more about this, I strongly recommend you go onto my YouTube channel and watch the video called "You've Been Lied To About Your Win Rate," where I show stats from actual traders proving this mathematically. Okay. Now, next, embrace losses. Just embrace them and be willing to learn from them. And sometimes be willing to accept them without there being anything to learn, because some losses are just part of the strategy and you should accept that. Okay. All right. Maintaining a consistent trading routine, discipline, execution. Now, 3 phases here: planning, reviewing, and rewarding. Planning, plan your trading day. This means you need a pre-trading ritual. You need some rituals that you do. If you've seen my videos on this, then you know I have a very extensive morning routine that I do to get my head in the right place. So you plan your trading day, then you define your entries and exit points, and you set your stop loss. That's your risk limits, okay? This is the structure for creating a trade that is disciplined, okay? And for this, I recommend you just use bracket orders. Easy answer, okay? Then you review. You review your trades, you identify areas for improvement, you make adjustments in your approach. This ongoing analysis ensures consistency and growth. Then number 3, you reward. Celebrate your success and acknowledge your progress. Positive reinforcement keeps you motivated and encourages consistency. And I'm not a huge fan of this part, but it is important to acknowledge yourself. Although it's also just as important to raise the bar once you reach one of your goals. And that's something I'm thinking about all the time. All right. So that's a little taste of Mark Douglas's 7 principles, okay? And we don't have time to cover all of them, but I will go over them with you again right now so that you can write them down. 7 principles of consistency. Number 1, I objectively identify my edge. That's your setup. Number 2, I predefine my risk before entering any trade. Number 3, I completely accept the risk or I stay out. Number 4, I execute my setup without hesitation when I see it. Number 5, I pay myself as the trade goes my way. Number 6, I continually monitor my susceptibility for making errors. Number 7, I understand the necessity of these rules and I do not break them because they are what allow me to be consistent. Okay. So those are Mark Douglas's. That's my take on Mark Douglas's 7 principles of consistency. Now let's talk about the 5 fundamentals of probability. Okay. 5 fundamentals of probability. Bobby, I have many live trading sessions on the channel if you want to watch them. Many hours. The 5 fundamentals of probability. Number 1, anything can happen at any moment. Number 2, don't need to know what's going to happen next to make money. Isn't that interesting? You don't need to know what's going to happen next to make money consistently. Why? Why would that be the 2nd fundamental rule of probability? Because it's probability, right? It's statistics. It's forecasting. You don't have to actually know what's going to happen. You just know that if you have a 60% win rate, let's say 6 out of 10 trades you win over time. So that's how you get rule number 2. Rule number 3, there's a random distribution between wins and losses for any set of variables set for any variable set that defines any edge, okay? This is basically saying that wins and losses are basically random until you zoom out enough. So you don't get caught up in the wins and the losses. Number 4, an edge is nothing more than an indicator of higher probability. That means one thing's more likely to happen than the other. And number 5, every moment in the market is unique. Every moment in the market is unique. So number 1, anything can happen at any moment. And number 5, every moment in the market is unique is basically the same thing. Okay, so those are his these are Mark Douglas's 5 fundamental rules of probability. Why am I sharing this with you? Because I want to show you that this guy is unlike any other person teaching trading psychology. This guy lost hundreds of thousands of dollars trying to learn how to trade. Not only that, he lost his wife and he lost his house. Okay, this is no joke. And that's why this guy is someone you should listen to, because he's been there.
I started trading like that. I went through, I don't even remember what my first trading account was. I think it was around $20,000. You know, I lost all of that, and then, you know, saved up some money and opened up another one for around 15, you know, lost all of that, and then went to another broker, and I'm thinking this guy doesn't know what he's doing, and I'll find somebody who does. And then this is what really, this is probably the reason I'm even standing here today, was this particular trade, because this particular trade it had a profound impact on me in terms of how it changed my life and what I was willing to do to find out what this was all about. To find out really what does it take to be a consistently successful trader? What does it take to really be able to earn an income as a trader? In 1980, I think, I was long silver at around $9.75 an ounce. And there's 2 5,000 ounce contracts at the COMEX. In other words, I was long 10,000 ounces of silver at $9.75 an ounce. And right after I got into the market dropped about 20 cents on me to about $9.55. So I was down $2,000. And my broker said, well, okay, you know, here's what we're going to do. Instead of getting out, we'll put you into a spread. And so what we'll do is you're long 10,000 ounces of silver in New York. We'll go short 10,000 ounces of silver in Chicago, because you could trade Chicago silver at the Chicago Board of Trade. Everybody with me on this? Just want to make sure that you guys are all with, you know, even though I know many of you are stock traders, the concept is the same, okay? So I'm long 10,000 at 975. He puts me short 10,000 at 955 in Chicago. So I've got this spread going on. And then he said, well, when the market goes back in your favor, we'll just take the short leg of the spread off. Now, keep in mind, back then, you guys are. What do you typically pay for commissions, even in commodities, or even, I don't know what you'd pay for stocks, but typically the average commission is about $4 to $5 a round turn, right? How much do you think we were paying back then? Yeah, 125. How's 125 a round turn per contract? So in other words, for me to put this trade on cost me $250. Okay. When he put this one on right here, it cost me another $250. And then he said, of course, that when the market goes back into my favor, he'll take the short leg of the spread off, and, you know, I should be all right. So that's exactly what the market did. The market went back up to, you know, right around the 975 area. He took the short leg of the spread off, and then the market immediately dropped back down another 20 cents and put the short leg of the spread back on again. So that's another $250, okay? Plus, he just locked in, when he took this off, first of all, he locked in a $2,000 loss by putting this trade on. When the market went back up to 975 and he took this off, he locked in another $2,000 loss. And then when it went back down again, he put it back on and locked in another $2,000 loss. Now I'm down $6,750. Okay? And then, of course, it happened 2 or 3 more times. Now, from the market's perspective, all the markets, the silver market's just in a trading range. That's all it is. It's just in a trading range. But I didn't know how to read chart patterns at the time, and didn't really understand what was going on. I was just listening to him. And so what he was doing was just taking advantage of the fact that it was going back and forth between support and resistance, and generating commissions for himself, okay? That was it. That's basically, he was just turning my account.
So he's watching the market bounce up and down between support and resistance. Support here, resistance here, trapped in this rectangle. And every time the price hits one of these levels, he's executing another trade and another trade and another trade. And he doesn't realize it's just a pattern, up, down, up, down, up, down. And the market is just screaming out, hey, we're in a trading range, just like this is right here, right? But he doesn't know what's happening. And while he's getting slapped around like this, his broker is happily collecting thousands of dollars in commissions. Now, for you watching this right now, here's the kicker. You can learn every psychological principle that we're talking about here. Every single one of Mark Douglas's 7 principles. But if you don't understand the basic chart patterns like a trading range, this is a trading range here. and this is a trend. If you don't learn the basic difference, where you can look at a chart and tell the difference between this and this, you're setting yourself up to fail. And think about that. You have to know when the market is stuck in a range. Otherwise, you're just pressing buttons, guessing when the price is going up or down, and just bleeding out money, just like Mark Douglas did. It was brokers back in the day, but now you'll just be at home over trading and end up blowing your account. So as we continue to master the mental game of trading, the psychology, make sure you also know the fundamentals, especially the difference between a trading range and a trend, because it is not an advanced concept at all. And knowing something like this could literally be the difference between continuing to make money in your account or blowing it all.
But here's the story, is that as these losses are mounting, okay, and I can't sleep and getting real stressed out. You know, I wake up one morning and I thought, you know what, this is it. I just can't take this anymore. I just can't take it. And so, you know, when I got to work, I called them and I said, you know what, just get out of the whole damn thing. I just can't do this. So just liquidate the position. Does anybody remember the Hunt Brothers silver debacle? Oh, it didn't. Does anybody, if I say the word limit up, does anybody understand what I mean by that? Okay, the exchanges will impose artificial price limits of how much a commodity, or even a stock for that matter, can fluctuate in any given day before they stop trading. So we don't have these kinds of moves too much anymore, but back in the 80s, limit moves were really quite common. They really were. In other words, what would happen is this, is that if the market went up, let's say, I think in silver it was 50 cents. I don't remember exactly what it was, but if the market went up by 50 cents, they would actually stop trading. Meaning if the market was bid up to, let's say in this case, $10.25, trading would stop. In essence, what this means is that at 10:25, there were no people, there wasn't anybody in the world, this is important for later on. There wasn't one person in the world who was willing to sell silver at 10:25 if it was a limit move. Not one person. And so what happens is that the price will go up seeking to find who will actually sell. So what the exchanges didn't want is there to be this huge fluctuation all in one day. There might have been sellers at 10.26, or there might have been sellers at $11, but you don't know that because the exchange says we're going to stop trading at 10.25. You guys with me on this? Okay. So what happened is that I don't think it happened more than maybe half an hour, 45 minutes after I got out. The market was trading right around $9.75 an ounce. Where silver went limit up. And went limit up, was 30 days in a row to $49 an ounce. To $49 an ounce. I was looking, now think about this, okay? Now think about being in this kind of a winning trade. Now, when we're in a winning trade, the market almost never goes straight up and it never goes straight down. There are rare occasions, of course, like in this case, when it does. So that when we're in a winning trade, we have to constantly be making decisions about where we're going to take profits and how much heat we can take with the market coming back against our position to say, well, is this a time to take profits? Or am I going to let it come back a little bit further? Am I going to come back a little bit further against me? Because, well, is this normal retracement or is this more significant, okay? Is this a little bit of a profit-taking retracement? Is it more significant? Should I get out now? Do we have more left? Are we going to make new highs? You got to be making all these kinds of decisions. And it's very difficult, as we all know, right? See, in this case, I didn't have to be making any decisions because the market went limit up 30 days in a row. Boom, boom. So I sat back and watched in complete agony. I mean intense agony. All I know is that I was within, let's say, a half an hour, 45 minutes of a monster trade. A monster trade. And like I said, I sat back and watched in agony as the market went up to $49 an ounce. I'm thinking to myself, I was like that close to $400,000. On just two contracts. $400,000.
If you want to download the infographic for the 7 principles of consistency, hit the link in the description and I've got it there for you for free. This was just an introduction to Mark Douglas. So if you want a part 2, let me know in the comments. Thank you so much for watching. Subscribe for more videos like this. Hit that like button if you liked the video, and if you didn't, that's cool. See you next time.